Well, good morning and welcome back to the Broadcast Retirement Network's BRN Sunday podcast. I'm Jeff Snyder, your host for the next 60 plus minutes as we go around the globe with members of the media, academia, and financial services to analyze all the news in retirement markets, technology, personal finance, and so much more. We've got another great show for you this week. This week, we've got a very special guest. We'll be joined by a partner with the CPA firm KBST&M, Mr. Michael Berman. We're going to discuss the aspects of the CARES Act. And if you've been checking out our podcast, special podcast each and every week, you know that we've been covering this issue. We're going to hear it from a CPA's perspective. So sit back, relax, and enjoy this episode of the BRN Sunday podcast. One, two, bring it to the foe. Snoop Doggy Dogg and Dr. Dre is at the door, ready to make an entrance. So back on it. We're going to kick things off with Oliver Rennick. He is the lead anchor for the TD Ameritrade Network. Oliver, how are you?
Doing great, Jeff. Just trying to survive quarantine like everybody else.
I think so. And hats off, of course, to all of our frontline healthcare workers and people who are supporting those people and supporting all of us, of course. But I really wanted to start out the show because you and the TD Ameritrade Network did something great last weekend. And so that we're recording this on Friday, airs on Sunday. But last weekend, I think I have my dates right because it all runs together, Oliver. You guys,
right.
The whole network did a 3+ hour live town hall called Navigating the Markets in Times of Uncertainty. So before we kind of get into the takeaways, how did this thing all come together? Because I want people to hear this. This is amazing.
Yeah, it was a effort by, I think, everybody that's usually on the network, but also kind of another part of the network team, which is those that are directly involved on the education and outreach side at TD Ameritrade. And these are the people and kind of the crew that often works on our market drives. So market drives are the events that are a kind of monthly, several times a year, where TD Ameritrade Network people come and speak with and meet with individuals and clients of TD Ameritrade and talk about the markets. And it's very educational. It's very helpful. And this time around, our executive producer decided, why don't we kind of there's already a need for this kind of special event type of scenario for markets where people want to interact. And, why don't we kind of blend our network coverage with the type of interaction and person-to-person education that comes with the market drives that we usually do in person. So it was a really creative event that I think blended two worlds really nicely. And it was very interactive. And it was all virtual. We had all of our guys and gals from the network, and then we also had some folks on the education side and the product side who were able to show people how to use the platform and talk about everything from basics to sort of advanced options type stuff. So we accomplished a lot, and at the same time, we're able to kind of give a current status of the market sort of update for folks who maybe haven't been quite as buried in the weeds as us on a day-to-day basis. So I think it was really good.
Yeah, I heard the numbers 1.8 million to 2 million people checked it out, and so that shows me.
Yeah, we had a ton of people watching. It was a lot of feedback, which was really exciting.
People were hungry for it.
Too many questions.
Yeah, well,
yeah.
I think it signifies that people are hungry for this stuff and they want something, and maybe it's something you do. I don't want to, tell you what to do, obviously, but maybe it's something you focus on every month or every quarter at least. Let's dive in because you had that. I was watching it, and the set looked amazing where you were, and your colleague was there with you, I think, and you were very well spaced away from each other. So you looked like you were at least 10 to 15 feet away from each other.
Yeah, we were socially distanced. I think appropriately, and then everybody online was quite socially distanced. So it was pretty cool. We had a cool virtual set. Our graphics team did an awesome job turning out this virtual set, and it really felt like everybody was there. And we were able to bring in everyone, JJ, Steve Quirk, Lorraine Kerr from the education side, and all the network people as well to talk about charts and options. I mean, it was a full staff.
So let me ask you just a couple of questions. I want to understand some of the key takeaways, but what's the general pulse you would say of people as it relates to the market? What were thematically, what were people, nervousness, bullish, bearish, or all over the place? What was the general consensus, do you think?
I think it's somewhere between kind of a shock and curiosity in a positive way. I think that there has been such a unique, ferocious event in markets now in both directions. This was prior to the big rally up, but markets had already stabilized. And actually, that was kind of the theme of our coverage. And now, in retrospect, was very poignant and to some degree a little bit prescient, because basically what we were discussing was this was after the week that markets had bottomed out, and they had a week in which they were a little changed to slightly lower coming into that weekend. And people's, I think, big overarching emotions were curiosity, number one, what's happening, why is it happening, and then how do I kind of pull apart all these moving parts, which is what we try to do every day on the network. I mean, the other part of it was just kind of like an excitement mixed with shock, where I know that there are definitely some people who were obviously very long the market that are hurting and got hurt, but there are also a lot of people, frankly, who were short the market. And you've kind of had this bifurcated experience now in markets for a while, where it's a little bit oversimplifying, I think, to say that a big down move was a blast to, everybody. Now, just by nature of how people invest in the markets, it was mostly negative. It was negative for most people. But there's been a good bit of the trading community, and because we talk to these people every month during market drives, we talk to people, guests on the network as well. Now, mostly the professional managers are long for the most part, but a lot of the folks that I've talked to and come to know that are active traders were short the market and looking for some kind of event. Now, nobody really knew this was this event, but so you have a lot of curiosity, I think, as opposed to like a fear or a like a morose kind of vibe. That is not really the feedback I got from people at all. It was much more curious, and that's perfect for what we do, because what we try and do every day is pulling apart the market. It's like, I kind of like the analogy of like when you put, well, I guess maybe not anymore because everybody has new headphones, but like the old cord headphones, you put them in your pocket for a while, and then you take them out, and it's all jumbled up, and you got to try and figure out how to get this straight line, right, and how to untangle it. And that's basically what we do every day, and the markets have been really, really jumbled up. So I can get into some more specific questions, but people had a lot of very specific questions about relationships, correlations, and why certain things weren't doing what they thought they would do naturally. And that consumed a lot of our question and answer period.
Yeah, so you kind of, it's like an education. People could come and be educated. Maybe they, like you said, they hadn't been following the market, or if they did, they only saw the macro. You see the unemployment numbers, but you don't really understand the interrelationships between asset classes or stocks and bonds and all different things.
Yeah.
I think that's absolutely amazing. I wanted to get, while I have you here, and we're going to talk to your ex-colleague now, Kevin Kelly, a little bit later on in the show about markets. But being that today is the close, we're doing this on Friday again, and the market's closed. What's your assessment, just from the point of doing the town hall, through all these? My wife and I check out the coronavirus task force press briefing every day to kind of learn the latest numbers. We watch at a very high level the markets. But what's been your sense the last, I guess, 6 or 7 days since the town hall in terms of the market?
Well, yeah, when we were doing the town hall, it was very much about how there were early signs of stabilization in markets. Volatility had been dropping. VIX had been dropping even on days where the market was down or flat. You had more traditional relationships come back into play. We saw bonds stabilize. We saw investment-grade bonds and credit markets stabilize after the Fed had already papered over those markets. Of course, this week the Fed came out again with a fairly shock degree of support. And I'm sure you'll talk about that with Kev extensively, so I'll let him take that into what it means for his part of the world. But our point of the town hall was that it looked like things were starting to normalize, and that there was a good chance that markets were looking at trying to rally and possibly sniff out the idea of a faster than expected return to normalcy. And again, we were doing that through volatility. We were doing that through talking about how stocks had been stable throughout the first week of that terrible data. This was after the first week where we had the 7 million jobless print and all that stuff.
Mm-hmm.
So that to me was a pretty profound period because markets told us through their price action that they knew these bad events were coming. In the background, that was when New York started turning towards potential peaking instead of getting worse. Now, the president had said, look, this next week, the one that we just went through, it's going to be one of the worst, and it was in terms of deaths. And there's obviously no making light of the situation when there's tens of thousands of people dying. But to see that New York and even Italy, where healthcare systems were very overwhelmed, that the overall path of the virus was still recognizable in terms of the way it progresses, in that it peaks out and then flatlines, is a huge sign that markets can now and people can start to understand and expect this virus to do certain things. Now, could there be another shock? Could there be a surprise? Absolutely. We have no idea. And I'm not qualified to say whether or not there's reinfection possibility or all these things, right? So there's still surprises that could be there from a biological standpoint, but so far, the virus looks like it's running out of surprises, and that's a very good thing. Yeah. So that's kind of the first step because that's the catalyst for the economic shutdown. So if the virus is more understandable, then we can start to think about the economy getting back to normal. And I think this week was really important because not only does it look like the virus, in terms of its lethality in the United States, is not going to be nearly as bad as people thought. That's very good. It also then suggests that a return to some degree of life will happen faster than we thought as well. That's the natural conclusion from point A to point B. If the virus is not as bad as we thought, which right now it's not in terms of the numbers that were originally expected, then our duration of our shut-in, which is what's important to the economic effect, might also be shorter. And stocks are rallying on this idea that maybe the worst is not actually going to happen. And I really think it's as simple as that. I think over the next week, we're going to be in for another really big test because then what does the market need to stay 30% off the low? Does it need something very extravagant in terms of progress? Does it need New York letting people go out? Does it need an announcement that, by the president that we're going to do something by some date? That's the next big question.
Yeah. And Oliver, a lot of Americans out there are looking at, they get the Dow Jones Industrial Average is something that they follow because every newscast on the major networks, they track that. And I was just doing, you and I were chatting and I was paying attention, listening to you, but I've kind of done a little bit of a I always pay attention. It's like listening to a professor when I hear you talk. But, we kind of ended the week at about 23.8 something, right? 23,008. And the last time we were at the same point was January 4th, 2019. And so for me, that kind of helps me, kind of relegate things and make things relative to one another. So just a year ago, we were kind of at this point. So it's not inconceivable. A year.
S&P is only down like 4% right now in the past year. Nasdaq's actually up.
Yeah, and so that's amazing, and I think that helps. For me, Oliver, and I'll give you the last word on this, of course, is from an education perspective, when you're feeding people information, you want to do it in manageable bites, right? Because you don't want to overwhelm people. You're not trying to prove that you're the brainiest person in the room, even though people know you are smart and your guests are smart. You want to feed people little pieces of information that they can digest, process, and synthesize.
Yes. Mm-hmm. That's right.
Well, we're going to leave it there, Oliver. Always appreciate you coming on the network. Glad you get a moment off and you can relax with your family. And look forward to having you back on sometime very soon.
Thanks, Jeff, and thanks for the interest in the town hall. It was pretty cool. So
actually, amazing.
Appreciate your curiosity.
Take care. Bye-bye.
All right, cool, man.
Welcome back. And now it's time to shift gears to technology. And there's obviously a lot going on with tech these days as people are working remotely and social distancing. And joining me on the line to talk about this and a lot more, Dan Klein, Senior Technology and Consumer Products Reporter with The Motley Fool. Hey, Dan, how are you?
Oh, wait, Jeff, people are working remotely. Is there something going on that I need to know about?
I have nothing at all, Dan. I mean, let's just be. It's a tongue-in-cheek show, I think, this week. Everyone I talk to, I think we're all kind of up to our gills, up to our ears in stresses of working from home and being isolated. So yeah, there's something going on. How are you?
Yeah, I'm good. And we're luckier than most because we get to talk to each other and we get to talk to people as part of our job.
Yeah.
And that's going to bring us to, we wanted to talk a little bit about Zoom technologies, and, which is video conferencing. A
Hmm.
lot of businesses were doing it beforehand. We've talked about it on the show. And now a lot of people are doing it. Just to give you an idea of how big this has gotten,
Yeah.
this went from a company that had 10 million users in December to having 200 million users now.
Oh Lord.
Now, imagine, Jeff, if you were 10 inches tall and then you grew to 200 million inches tall. So, Credible Hulk, Apache Chief, Ant-Man, however you want to go. People forget Ant-Man can also go in the other
Oh, I
direction.
didn't know that. Okay.
Yeah,
Good.
it happened in a couple of the Avengers movies. In the comic books, it placed great stress on his heart and was very bad, and he's not supposed to do it. But they didn't bring that up in the Avengers movies. So this is one of those scenarios where because Zoom grew so fast, that exposed security flaws. Previously, if a company used Zoom, they put protocols in. Meetings had passwords, some of the safety things were enabled, IT departments were adding their own levels of procedures and checks. Well, when my mom starts using Zoom, or her friends or whoever else is out there, just, how many virtual Seders did you see last night? Most of those were on Zoom. Happy Passover.
Yeah. Happy Passover to you, Dan. That's a great way to celebrate, I guess, in
Yeah,
today's
and I,
environment. And Easter coming up when we're playing this show. So yeah, I think there's going to be a lot of using the technology to sit around and say the four questions and do other things.
Yeah, and that led to vulnerabilities that previously hadn't been exposed. I'm sure you've all read about Zoom bombing, and Zoom bombing is when someone breaks into your Zoom and they probably don't do it just to do something wacky. They're probably showing something offensive or being vulgar. And that's scared a lot of people away. And it's hard for me to not talk about this as an investment because I've been talking about it as an investment so much. But as a user,
Hmm.
there are some things you can do. And the biggest thing you can do is make sure you're using passwords. If you set a password, okay, you have to give it to the family, you have to share it to the people. That's going to correct most of your problems. So are there vulnerabilities that go beyond that? Maybe, but I don't think the average hacker who's looking to play a practical joke is trying to break into your meeting all that hard. They're just looking to exploit the easiest vulnerabilities. So don't be afraid of this technology. Embrace it, but put in the safety checks. It's like one of those things where sometimes on your computer you could turn off some safety things and it asks you like, really? Like you want to turn that off? Uh, Listen to it, use safer practices, and be patient. Your older relatives who've never video conferenced before may not know how to do this. I had to deal this week with my wife sent my mother-in-law an Instacart order. For those of you who don't know, Instacart is a delivery service. They will pick up from supermarkets and Costco and CVS and a bunch of other places. And we place the order, and my wife is monitoring it for substitutions as it's being placed. But my mother-in-law fully could not understand why they would not call her and just tell her, oh, hey, you can't get this, you can't get that. And then when the order showed up and there were some substitutions, she was not pleased with her grocery order that she didn't pay for. But this is one of those things where you're going to have to be patient with people who haven't used technology. So you might want to write up some simple, really explicit instructions for people in the family that haven't done this. But this is an amazing way to connect. And my wife had a virtual happy hour last night with her office, which for some reason had to be a non-alcohol happy hour. Happy hour. I'm not sure why at home you couldn't have a drink, but they couldn't. But I heard laughing
Interesting.
from yeah, I heard laughing from the office and people were clearly having a good time. So I would really tell people it's a lonely time. I see my wife, my son, my cats, and from 20 or 30 feet away, the woman who owns the co-working space where we are right now the only two people in, and maybe wave at some people walking their dogs while I'm working out outside. This is a lonely time. Make an effort to connect. Pick up the phone if that's how you're comfortable, but adding the picture, doing a little video, whether it's Zoom or a Slack meeting or all the other technology, a FaceTime, it really helps.
Yeah, I think these are, I agree with you, lonely times. And I know we're going to cover the elderly and how social distancing has been really hard created hardships for that group of people in our country and around the world. But Dan, let me go back to I'll come back to the security issue in a second. But how about bandwidth? Right? Are there challenges when you go from whatever 10 million was the number I think it was, and now it's 200 million
to 200 million?
Does that create bandwidth or challenges from an infrastructure point of view for a company?
So amazingly, it hasn't. And I am fully surprised that they've been able to keep this up. And absolute kudos to them. This is very impressive. Where you are seeing bandwidth issues is people's houses. So I live in a building. My internet is shared. It's funny. My internet company is called GigaMonster. It's to imply that we have a gigabit of internet, and maybe we do shared between 350 apartments, but we certainly do not. My regular Wi-Fi, when I was running speed test, which I did really often because I'm broadcasting sometimes from my office, and certainly doing meetings where it's not always great to drop off. And in those cases, I would sometimes see barely enough speed to do a voice call, let alone a video call. So there's two things you can do to improve that. If you have a Wi-Fi router and you can plug into that Wi-Fi router using an Ethernet cable, that will generally increase your speed maybe tenfold. Now, that's not always easy. If you have a Mac like I do, you need an adapter to do that. Those adapters are available on Amazon, but they take maybe 7 to 10 days to ship. Maybe you'll have a better chance getting it quickly at Best Buy. You also want to make sure if you're doing a lot of things that need better internet, you want an adapter that also has a place to plug in your power cord if you have an older Mac that only has one USB-C port. The other option, and this is the one that's actually worked for us really well, is we bought something called a mesh router. So we have about 1,300 square feet, and the router is sort of to the far left end, if you're facing my television, of my house. So it's reasonably far from my office. So what this router does is we got two of them. It's called Eero. We bought it on Amazon, but it's an Amazon company. There are other routers of a similar ilk, but I trusted Amazon. It made sense. So it took 4 or 5 days to show up. It's two little white, squares, rounded squares, I guess you'd call them. Plugged it in. There's an app. It took about 15 minutes to set up, sort of on top of my existing network. Plugged the other one in right next to where my office is. Set that up in about 2 or 3 minutes. And my internet speeds are 5 and 6 times faster. I've had no trouble doing live video broadcasts from my office. And that's obviously not something the average person is doing. They don't need that level of quality. So if you have an extra probably around $200 to spare, and then the internet is important to you. The cool thing about this is when this whole crisis is over, I still have this. There are a lot of things I've purchased, exercise equipment, that when this is over, I'm going to go, where do I put this? Like, I don't really want to have an ab roller in my living room, 3 months from now, but a better internet router is absolutely an investment that I think most people will see benefit from for the long term.
I agree, and I think it's going to be necessary as we all. I see us having a new normalcy, which we've discussed this week on the network. I want to talk about security again, Dan, and the thing that really concerns me is stimulus. We've got these stimulus checks dropping, I think beginning next week, or stimulus proceeds, right? Because if you have a routing number and a account number and you get direct deposit, you're going to get direct deposit if you qualify for this. So, but what I have seen is a rise, Dan, in stimulus check and SBA scams. I'm really concerned about this because we already have scams in so many other areas, and these people are just like these hackers and people are licking their chops.
So here's the deal. These payments are coming through the IRS. If you filed your taxes electronically last year, I will point out that I did not, because we got identity frauded a few years ago, and I have to file paper taxes. I am pretty sure I do not qualify for a stimulus check, which is a blessing. I'm still working. I don't want one. So I'd much rather the money go elsewhere. That's, of course, not how it works. But that said, if you filed your taxes electronically and that bank account is still your bank account, you can have other bank accounts, but if that's still in your name, in theory, as these checks start to come out, it will just show up $1,200 per adult, $500 per kid. If you make over a certain amount of money, it starts to phase out at, I think it's about $199 a joint in net income. I think it's net income for a couple. You won't get anything at all. But hopefully this just shows up in your bank account. If it does not, you should be very wary of a couple of things. The IRS will not call you. The IRS will not email you. The only way the IRS will communicate with you is either you reach out to them via phone. That is going to be a terrifically long wait. They will likely put up some website ways to apply for these checks if you haven't filed your taxes yet. If you didn't have to file taxes, there are certain people that don't. There are seniors that don't. There are methods in place for some of those, and certainly Google it and look for credible sources like Motley Fool, Wall Street Journal, New York Times, places like that to tell you how to do it. Don't look at, taxdebtinformer.com. I'm just making that up. That's probably not a real website, but you get what I'm saying. And don't trust anything purporting to be the IRS except for mail. The IRS sends you mail, and you can tell it's from the IRS. It's always chock full of expensive printed things giving you all your rights. If you're just getting a thin letter and it's not on official IRS stationery, that is a scam. If it's a phone call, if it's a web solicitation, anything other than you reaching out to them, and if you are skeptical of something, it is not fun to do, but put yourself on the 3 or 4 hour hold and verify everything. So for most people, read the newspapers, follow USA Today, the places that are talking about when these checks are coming out, MSN News, there'll be stories everywhere about when you could expect it. The same way there are stories about how refunds are being doled out. So don't bother the IRS if you don't get the check on April 9th or April 11th and it said that's when it started. The reality is this is going to take a long time for most people. And with the Small Business Administration loans, obviously desperately needed loans, a pretty good program, banks are being overwhelmed. The place to start is if you have a relationship with a bank, start there. Find out when they can talk to you, if they can work it out. If you do not have a relationship with the bank, maybe just start with whoever has your bank account. I mean, most businesses have some level of bank relationship, even if you don't have a person you talk to. You're going to have to be patient for a lot of this, and it's not that fun to be patient when you're not working. The same is true when it comes to filing for unemployment. There is a backup in a lot of states. We've talked about this before. The websites for most states for things like unemployment, and I'm lucky, I have not had to file unemployment for more than a few weeks, maybe 10 years ago, and I did it in Connecticut, and it was a freaking nightmare, and it's really complicated and a lot of pages, and I'm guessing it's exactly the same now, and I ended up doing it wrong and taking unemployment for a week that I actually got a check, which came with all sorts of tax penalties, and if I had to file again within X years, I wouldn't get it for 2 weeks, and it wasn't anything intentional. It was just very confusing. So be careful, get help.
Yeah, I just want to stress that what Dan just said, the IRS is not going to email you. They're not going to reach out to you. People listening to this need to make sure that they are not handing over their banking information, their social security information, so that bad actors can tie this and get and steal, basically, because they're going to take this banking information, replace it with theirs if they get it, right, and your social security number, and then have the stimulus checks come to them. And I just got to, from a moral perspective, Dan, I just find it absolutely absurd that these people, and I don't know where they are. I don't know if they're here in the U.S., if they're abroad in bad acting countries, but it just seems to me that people would take a break from acting bad. But that's just human behavior.
Let's hope, Jeff, that this is a very small class of reprehensible people.
Yeah.
These are probably likely bots in most cases. And I'll say with anything else, no legitimate government organization will ask you for iTunes gift cards or any weird method of payment. If the IRS needs money from you, you will get a letter from the IRS explaining what the situation is,
Yeah.
giving you 30 days to rectify it. I had to deal with my brother, his legal address was my house for a few months, and the IRS questioned a piece of his tax filing. And it was pretty easy for him to rectify, but it's of course scary to open your mailbox and see the IRS letter in there. Thankfully,
Absolutely.
it wasn't for me, so that was nice.
As
And
long as
he
it's your
had
brother.
yeah, well, and in his case, once I opened it, I knew it wasn't an issue because I saw what they were asking for, and I said, "Oh, he's just going to have to send over documentation." Most IRS interaction is what's called a paper audit. It means you said, "Hey, Jeff claimed trip to Vegas, $3,000 for a trade show on his travel and entertainment, and you can deduct half of that." And they come back and they say, "Hey, like we think this is a pleasure trip. Can you document that it was a business trip?" And Jeff pulls out his registration for a conference. That was $600. His hotel room, his restaurants, different things you can take half, different things. I think the registration you can actually take all of. And he sends it in, and they send him a letter back saying, "Oh, hey, that's great." The IRS can be confounding. I remember one year I got a check for $6. I had overpaid by $6. And then a month later, I got a letter saying I owed $6. And the language in the letter where you owe $6 is roughly the same as the letter where you owe $10 million and have been hiding for 6 years on a deserted island. The IRS does not message particularly well. So if you need help, if you get something scary, find an accountant, find the certified person, find a friend who knows how to navigate this, and recognize that as scary as some of the IRS communication is, generally my experience has been if you call up and get a person, they're willing to work with you. They don't want to go after you. They're certainly, don't want you to be scammed. So they're going to help you. When I had my taxes, someone file taxes in our name, and I needed documentation of my taxes for a mortgage, there's rules about what they were allowed to send out. And they worked as hard as they could to get my mortgage company what they needed when they could not release my taxes to my mortgage company, because that is just something that they can't do once you've been defrauded for a certain period of time. So, scary organization, but nice people inside.
Yeah, absolutely. And you just have to be vigilant. We have to be even more vigilant in today's environment. Dan, always a pleasure talking with you, and I'm looking forward to having you on the network on Tuesday to talk a little tech. And I know we're going to talk a little football tech, maybe, draft tech, and we're also going to talk social distancing and isolation for some of our elderly. So look forward to having you on, and we will talk to you then.
Hey, yet another year I'm not getting drafted into the NFL, but I will see you. I will see you then.
You and me, brother. Bye.
I'll talk to you later.
Welcome back. We're going to talk now about the CARES Act. And we've done it. We've had the Illegal Eagles on talking about some of the provisions during the week. And on the podcast in previous segments, shows. But I'm really pleased to involve now Michael Berman. He is a partner with the CPA firm KBST&M. Michael, thanks so much for joining us on the program today.
Thanks, Jeff, for having me.
Well, it's good to hear your voice and good to chat with you. And kind of before we launch into kind of the differentiation and the pieces of the CARES Act, from your perspective as a CPA, how's the family doing and how's the firm doing in terms of the social distancing that we're all practicing?
Family's doing well. We're adapting to this new standard, and from a firm standpoint, we are all working remotely, so it's a lot of virtual collaboration using Zoom and different remote access tools to assist with people with Skype Messenger. So yeah, some of us are more familiar and acquainted with it, and others it's a completely new adventure. But everybody's been adjusting over the past couple of weeks.
Well, that's great. And so business as unusual, business as normal, I guess, but with a few changes. So, Michael, on this network, we've been talking about the CARES Act and some of the provisions, but I think what would be really interesting for the audience is to hear from your perspective. You're a certified public accountant. The firm does a tremendous amount of tax returns. You help clients, small business clients. You help individuals. You help married couples. Why don't you give us your perspective on CARES?
Sure. So let me just start off with one of the first items that people are going to notice with with regards to the CARES Act are the stimulus checks that will be coming out over probably the next couple of weeks if you had direct deposit set up on either if you did your 2018 return, and that would be either a direct deposit for a refund or a direct debit for a payment. So that means that the IRS currently has your bank account information available and accessible to deposit your stimulus check. And it looks from all indications, that's going to be starting in the next 2 weeks or so. That's kind of what I see as the latest on the IRS website.
Okay, good.
Now, if you did not use a bank account listing for direct deposit or direct debit, then you will be actually receiving a check in the mail, and it will come to the last address that was known to the IRS at this point. Those checks are probably going to not happen until sometime in May or so because of it. Just the processing time takes a while. I have seen that the IRS is looking to have something on their irs.gov website where you can go on there and I guess enter some specific information about a return to validate, and you would be able to add your bank account information so that your stimulus check could come directly into your bank account. It's currently not on the website now, but from what I see, they are discussing it, and you'll probably want to take a look on the irs.gov over the next week or so for more information about where to go on there to enter your bank account information for the stimulus check.
Yeah, Michael, is there a way for people to verify whether or not they're getting one? I mean, I know that there are certain income thresholds, right? I mean, you have to have $75,000 as an Indian, up to $75,000, and then it kind of comes down up to a certain point. And if you're a married couple, is there a way to validate that? Number one. And number two, is the stimulus check considered income for the purposes of taxation in 2020?
Good question, Jeff. So
I try.
So there are credit calculators out there on the internet. If you do like a search on stimulus credit calculator, you should be able to find some where you enter your income from your last filed return, and you put in how many dependents that you had under age 17, and it will determine what amount of the stimulus check you will be receiving.
Okay.
We also have it on our website in our blog at www.kbstm.com. Now, with regards to the phase outs, if you are single, the maximum amount you would get is $1,200. If you have any dependents under the age of 17, it would be $500 per dependent. Now the phase out starts at $75,000, and it's all, you would have no stimulus check at the time you reach $99,000 of adjusted gross income. Now the stimulus checks are not taxable. They really are just an advance credit against your 2020 income tax. So in other words, it's almost like they are providing you a piece of your refund in advance. Now with the married, if you were married filing joint, the maximum stimulus check would be $2,400, and again, it would be $500 per dependent for children under the age of 17. The phase out starts at $150,000, and it would be completely gone by the time you have adjusted gross income of 198,000.
Okay. And Michael, you made a really good point. I want people to be aware of this. You're actually kind of borrowing against your future refund. But what if you don't have a future refund? What if you are owe money, or what if you break even and you don't, you don't owe anything? I mean, does that mean you have to pay back? Is it like a loan in a sense?
It it is actually as a loan. There was some confusion
Yeah.
earlier on about whether or not if you weren't really entitled to it, whether or not you would actually have to pay it back. And from what I've seen from some newer information, I guess after guidance with the IRS, it does sound like if you weren't supposed to actually you weren't entitled to it, you would have to be paying it back with your taxes in 2020.
Hmm. Okay. Well, that's good to know. I think people really need to understand that this is not just free money. That, whenever these bills are scored and done in the Congress, right? I mean, they have to figure out where they're going to pay for it, right? And that's very important. So what they're doing is they're just saying, okay, well, we're expecting we would probably typically receive this amount in total refunds in 2021, and so therefore we're going to just borrow against that, and therefore it probably doesn't add up to the it doesn't find its way into the national debt, I guess, is kind of how I'm kind of
Yeah,
thinking about it. But maybe I'm wrong about
correct.
that. Okay. Sorry, I didn't mean it.
No.
I completely took you off of your thing, but that's my job as the host. Um, this is
Yeah,
this is important to kind of keep. I think the thinking here is this is important to kind of keep the economy going. I mean, $2,400 or $1,200, probably really not that meaningful, Michael, in terms of paying people's expenses. I would think. I mean, rent, car loan, food. It's a lot more than $1,200 and $2,400. I would think.
absolutely. And it's just a little addition to to help everybody out during this time of need. I also wanted to add one
Sure.
one other point, because there are a lot of people that are either retirees or people that are on Social Security disability that are not required to file a tax return. And there was some discussion whether or not they would actually have to file a simple tax return to receive the stimulus check. And the latest guidance is that they will not have to file any return, and the IRS will rely on information from the Social Security Administration to provide the stimulus checks, as well, I believe, if using the Social Security Administration bank account information to direct deposit the stimulus checks that have already been set up for either Social Security retirement or disability payments.
Okay. Yeah, that's good to know as well, because there was a lot of confusion over that from what I've understood from both you, our contributors, and just hearing about this stuff. And look, I just want to say this again because I think we need to keep our expectations aligned. This is a lot happening in a short period of time. The stimulus was passed a week ago last Friday, or a week ago from last Friday, a week prior to last Friday, and there's a lot of apparatuses that have to be set up. So I think people need to kind of roll with the punches, so to speak, and that things take time to set up. Michael, I want to shift gears to small businesses and businesses, because that's a big part of this as well. Many businesses are shuttered. They're not actively, if they are getting business, things like restaurants and local businesses can't do business, or they are limited in what they can do. And there are some programs out there that are available for those businesses as well as larger employers. What can you tell us there?
Sure. The two largest programs that were announced about 2 weeks ago are, the one program is called the Economic Injury Disaster Loans. It's called the EIDL loan, and that loan actually is directly through the Small Business Administration website, and you can actually complete the loan application online if you are a business, and you have to have less than 500 employees, the loans are really designed as working capital loans to kind of help with payroll, your expenses, any debt that you have to pay. Um, the rate on it is about 3.75%. The one interesting thing is that there is no personal guarantee that's required on this particular loan, and it's really just based on your credit score.
Okay.
Now, what we've been advising clients to do is to at least go online and sign up the application. Since it's directly online, it's really only asking for some basic information from your 2019 business return.
Yep.
And the one bonus on this particular loan is there's the availability up to a $10,000 grant, even if the loan is not approved. So there's the possibility that you would receive up to $10,000. And now the one thing, if you do receive that grant, you would have to understand that any income you receive from the grant would be taxable in 2020, but it's almost like a small little business stimulus.
Yeah.
Now the larger program that a lot of small businesses, even self-employed individuals are looking at is called the Paychecks Protection Program. It's called the PPP. Now that program also is for people or businesses that are less than 500 employees. They've been operating before February 15th, 2020. As I mentioned, self-employed individuals and sole proprietors, they are allowed to go for this program as well. The main factors in determining the amount of loan that you may be able to get, this is also through the Small Business Administration. However, you have to apply directly with your bank that you have your banking relationship with for business, or if you're a sole proprietor, whichever applies.
Nope.
So the way that the loan is calculated is it's based on your average payroll cost during 2019 for a month. So typically what we've been having our clients do, and some of the payroll services have been working up reports to assist with the clients, is you have to take what your total payroll is for the year, the gross salaries, and you are able to utilize that figure for the year, the amount of state unemployment taxes you pay for the year, any group health insurance premiums that you pay, and the retirement contributions as the employer that you make on behalf of the employee. So you would add all those factors up. You would then divide that number by 12, and that would come up with your average monthly payroll cost. And the multiplier that you would take for this particular loan is 2.5. So you would take 2.5 times the average total monthly payroll, and that would be the maximum loan that you would be able to receive for this PPP loan.
Okay, and Michael, if you do the previous the disaster relief loan and you get 10,000, are you also eligible to receive the PPP, the payroll protection plan loan, or loan? I'm sorry, yeah.
Sure. So that's a really good question, Jeff. So with the PPP program, if you received a loan from the EIDL, that loan would almost get piggybacked or refied under the PPP loan. So you would have two loans at first, but then it would almost be like an automatic refi, and it would lower your maximum loan that you would be receiving under the PPP program. So it does take the other EIDL loan into consideration when determining what the maximum loan is. Now, right now, a lot of people are currently applying for both, so they don't necessarily have, if they apply for the EIDL loan, they don't know what their loan amount is. So we figure that the banks are going to work that out at some point in the hopefully in the next couple of weeks. As we were saying before, it's a very fluid situation, and we're all trying to learn it at the same time. The banks really had to step up their game and get this whole PPP loan process online within a week to 10 days. So I mean, it's just a lot to comprehend and get moving on the web.
Yeah.
Now,
go ahead.
I was just going to say one item when you do receive your PPP loan, you have the ability to have some of it be forgiven if at least 75% of the loan is used for the payroll portion, meaning like you are paying, you have to keep the same amount of people on staff as you had before, so that way you're able to get this loan forgiveness. So of the loan, you would have to at least have 75% of it related to your payroll cost. There are specific factors that can be used for the remaining 25% of the loan, and that's really it. So that the 25% is really related to rent.
Yep.
It's also your utilities and any kind of interest on a mortgage that you currently have in your ordinary course of business.
Yeah. Well, I just want to go back to what you said. I want to echo that. This is a fluid situation, and I commend the banks for stepping up. But there's a lot of programming and things that had to happen in order to put this stuff out. And I'm sure that there are, when anytime a new program rolls out, typically you have a year to make changes, right? I mean, you get new regulation, or you get a comment period with the federal government, and then you have time to plan. This is something that is done in like 10 days. So it's absolutely, I have to give credit where credit's due. Everyone involved, from the Treasury to passing the legislation to the executive branch to the banks. I mean, they have really stepped up, and all the ancillary support partners here. It's absolutely amazing. Well, Michael, I just want to say thanks so much for taking time out of your busy day, because we're all working longer hours to support our clients. Really appreciate you giving us details, and we'll look forward to having you back on the program as things begin to evolve.
Sounds great, Jeff.
All right,
thanks for having me again.
Thanks, buddy. Take care.
Sure. Bye-bye.
Welcome back, and then I'm going to chat markets. And even though it's Good Friday, there's lots to be gleaned from market action this week and in the past, and from economic data. Joining me on the line, he's the co-founder of Delphi Digital, a cryptocurrency research firm, and a former equity strategist. Let's welcome back to the program, Kevin Kelly. Hey, Kevin, how are you?
Doing great, Jeff. How about yourself?
Doing okay, all things considered. It's not easy working remotely, but I have to, give credit, of course, to the frontline healthcare workers and those that are out there supporting fellow citizens during this very difficult time. So I really have no complaints.
Absolutely. Couldn't agree more.
But as I mentioned, Kevin, today is Good Friday, and markets are closed, but that doesn't mean there's not a lot to talk about. And my understanding is that but unemployment claims went up and were released today, so that went up significantly. But I want to get your point of view, because your firm just released a market assessment. So why don't you take us through the week and give us your thoughts?
Yeah, no. So I mean, certainly today, Good Friday, I mean, stock market's closed, but the beauty about crypto is it's 24/7, 365, right? So it trades today, it trades on Christmas. These markets never close, which I guess is kind of a good thing and a bad thing, depending on what you're trying to do with your time. But no, I mean, yeah, we released we release a weekly market commentary every week, commenting on what's going on in the crypto space. Big focus on Bitcoin, obviously, and then what's going on in kind of broader markets and tying in the macroeconomic backdrop to everything. And so, what we've seen recently, obviously in traditional markets, you've seen, the equity markets really kind of bounce back. You've seen the S&P's up, almost 25% from its March 23rd bottom. So a very kind of steep relief rally we've seen so far. Part of our commentary is certainly still a bit concerned about how quick this relief rally has been. And when you look at kind of the fundamental backdrop, I mean, things are still certainly, we believe at least, that things to the downside risk for equities is still pretty substantial, at least compared to what your upside is at this point. And if you look at kind of the construct of that rally, I mean, it's really been led by some of the worst hit sectors and the worst hit names, right? So energy, for example. We know when oil prices fell off a cliff, about a month ago, you had energy stocks really underperform, right? And so actually, since the market's bottom on that March 23rd date, energy stocks were up. I think it's somewhere almost north of 45%, right, compared to about 25% for the broader market. So really being kind of led by not necessarily the sectors that you would expect or want to see leading the equity market higher if you thought this was going to be a kind of a sustained rally. And so why I bring that up and why we think it's important is because Bitcoin, certainly over longer time frames, we've talked a lot about how it can be an uncorrelated asset in a portfolio structure. But at times when you see significant kind of spikes in market volatility, Bitcoin tends to kind of trade as more of a risk asset, right? So it'll sell off with stocks. Mm-hmm. And it'll coincide with those types of moves. And what we've seen recently, obviously, was a huge spike in equity market volatility. We saw a big drop down and drawdown in Bitcoin. And we've actually seen Bitcoin kind of rally back alongside stocks since that March 23rd date as volatility across markets has kind of waned a bit, right? And so what our commentary this week was basically saying, we're always trying to be optimists in this space, but we're certainly cautious at this juncture because, again, if you do see another leg lower in stocks and risk assets, and you do see volatility pick back up again, certainly wouldn't be the first time or probably the last time in which you see Bitcoin and the crypto market more broadly follow suit. And we're actually starting to see a little bit of that today. Again, stocks are closed today, but I mean, Bitcoin's down from around 7,300 when we put out this report Wednesday night, and it's now hovering around 6,800, right? So it has pulled back, a decent bit here. So again, just kind of in general, a little bit more cautious right now, even though the equity market seems to be telling a very different narrative than what a lot of people are seeing, in the headlines or on financial media.
Yeah, and you bring up a really good point, and this is why I always urge people, stop watching the markets. If you're not a daily trader, even if you are a daily trader and you've got this long-term vision, you got to stop listening to the news media, stop watching the markets, and just kind of buckle up for what will presumably be some type of recovery. Kevin, does it worry you at all that we're all working from home remotely, that we don't yet have plans to kind of restart the economy? I don't even know. I mean, some of us are still working, but like restart things and get us out there. That to me, I don't know. I mean, I've seen the market go up over the last 4 days. Great, right? That's great. We all want to do better. We want to get back to that 29,000 or close to 30,000 as we can. But right now we don't have a way to turn the spigots back on. That concerns me.
Yeah, no, I mean, I definitely think and again, it's still an overlaying concern just in general markets and the economy, at large. But to be honest with you, I mean, I think it is still, far too early to try and, reopen the economy for lack of a better word, right? And I think the longer we take, and what I will give credit to, I mean, I sit here in New York with you, and what I will give credit to, a lot of our leaders here is they have been, especially in the last few weeks, very kind of blunt and upfront about the situation that we face, right? Mm-hmm. And they're not saying, hey, listen, we're going to try and open up, New York City, the concrete jungle by Easter, for example. This is going to be something that, people are going to have to start getting used to because this kind of self-quarantine period and this social distancing, at least, even when you start to reopen the economy in phases, is going to be here to stay for a while. Because again, you really want to kind of nip this thing in the bud as much as we can. And so I think, it's a double-edged sword where, yes, obviously we all, are probably getting a little bit stir crazy. And literally, as I'm talking to you now, I've got my head out the window. I'm looking out the window and I'm seeing two people are literally running with masks on, right? Like, it's a very different, kind of paradigm that we're in right now, and period that we're in right now. And so, double-edged sword, we all want to be back out there and, obviously enjoying friends and family and things of that nature. But I do think the amount of concern and the amount of worry that a lot of our leaders still have, I think honestly has given me a bit of reassurance. It almost makes me a little less worried that we're kind of on the right path, because if they're not worrying, then someone else would have to, and that would fall on us.
Yeah, that's true. I mean, to some extent, I agree with you on that. Unemployment numbers obviously spiking, people being laid off. In fact, before we went live, I saw that the XFL was just folding.
Oh, really? I didn't see that.
Yeah. Just
that's unfortunate.
I say that kind of tongue in cheek, but
Right,
it's not the first time that this league went belly up. But I mean, it just is symptomatic of the future and not knowing what the environment, as it relates to media, as an example, not knowing what that environment is going to look like for sports like the XFL, like Major League Baseball. But then when you break it down to some of these other business lines, airlines, are we going to get back to flying? What's that going to look like? Is it going to be in 60 days, 90 days, 6 months? Is it going to be, or is it going to dramatic? I think there's a lot of unknowns here that has a lot of people concerned.
And I think there's going to be some pretty drastic changes that come out of this, right?
Yeah.
And maybe that's a bit obvious at this point, just given how long this has gone on and how long we expect it to go on. But talk about business travel. I mean, how many people out there have started to get into the groove of working from home, scheduled meetings virtually, or using things like Zoom, and now realize maybe they didn't their productivity or the things that they were working on didn't necessarily, drop off a cliff as they had to work from home. And now, if you're having a meeting or you're having a call with somebody, maybe it's an Asian partner or somebody in Europe who's a potential client, do you necessarily need to make that trip, right? Now, it's not to say that face-to-face business is going anywhere, but I do think it's going to result in some serious changes for a lot of people who maybe were concerned that, working virtually would make them less productive or make their companies less productive. And now it's kind of this perfect test case to say, in some cases, there's probably some efficiencies or improvements that they've made, right? So I think there's certainly going to be a lot of changes that come out of this. And that's part of the work that we do too, from a macro perspective, is just trying to understand what that paradigm shift's going to be, what it means for general markets, and what it means for crypto specifically too.
Yeah, and how will firms do due diligence? We talked, I think last week with Devin Banerjee about M&A activity slowing down significantly because you can't get face-to-face to do the due diligence, can't open the books, you can't meet the teams. There's concerns about retention of key team members, things like that. And I think that's just kind of symptomatic as as like an unknown or and how would anyone know, right? We don't know. And then you see some of the analysts' numbers, from some of the bigger, larger firms and investment banks of like what the GDP will be. And again, I think it's all, I personally believe that they're throwing darts at a dartboard and they're saying it's going to be down 30%, it's going to be down 20%, and people are saying it's going to be X, Y, and Z. I don't see how you could possibly know because there's just so many iterations of what this and permutations of what this could look like. So I think longer term this gets, and when I say longer term, I think if you're not retiring now, if you're not needing the money now, I think you look, prospectively, I should say, out past 12, 18, 24, 36 months and realize that's kind of the bellwether by which we're going to benchmark ourselves.
Yeah, and the retirement thing's a very key issue right now too, because again, when you have asset prices drop as far as they did, and again, you've seen a bit of a recovery, but when it comes to again how pensions are allocated and the underfunded problem that we've talked about, consistently, that was at a point when you had the longest and one of the best bull markets in history. Now in this environment where again, I'd like to be optimistic and say that 36 months from now, Do I think that the market comes back? Yes, absolutely. But again, in that shorter term, people are retiring. That maybe doesn't necessarily stop some of those plans. And if you're actually pulling money out of the market at a time in which asset prices are have suffered some significant declines, right, and are depreciated, it can certainly, I think, spell some issues or accelerate the timeline in which we really see this kind of inevitable pension crisis start to creep up on us.
Yeah, and you bring up the pensions, and they always maintain a liquidity buffer, like a cash buffer, in order to make the monthly payments, right? You've got to make monthly payments to your retirees, and at some point, and I'm not saying this is the case now, but at some point, you have to validate whether you have enough. You have to move money around in order to continue to maintain that cash position in order to pay benefits. And obviously that's going to vary by population, employee population, retiree population, by state, by county, by municipality, by company. And so I think that's something that still needs to be kind of validated. Last set of questions I'll ask you, Kevin. We have talked over the years, you and I and others on the program, about alternative investments. And I would categorize real estate, hedge funds, cryptocurrency as alternative investments, meaning they're not public market investments that can be invested upon. And just looking at the hedge funds as an example have always been touted as being sophisticated and algorithmically able to handle this market, a market that is complex, right? You can do options and puts and derivatives and all these types of things to allay yourselves of significant risk. And even, I was looking at first quarter results for things like hedge funds, not good, still not good. Now you can put that in relative terms compared to a index fund or compared to a actively managed fund. But I wonder what will happen in terms of portfolio allocations for some of these larger pools like endowments, foundations, and pensions.
Yeah, well, I mean, one thing, and the trend, again, passive versus active, one thing that we've talked about is you have a lot of the, quote unquote, active managers who are kind of closet indexers too, right? And I think what this period will do, again, ton of pain going on, but I think the silver lining in all this is that the next, let's call it 2, 3, maybe even 5 years, as you see kind of the unwind of passive that we've seen, and again, a couple weeks don't necessarily make a trend, but as you see kind of the markets wait out, I think this really does become an opportunity for active management to really outperform, because again, when you're buying things like the S&P 500, or you're trying to get, let's say, small cap exposure, and you're buying an ETF or a mutual fund that tracks, the Russell 2000, for example, I mean, you're at liberty of kind of the broader macro moves, and you aren't able to put on, let's say, some of those strategies, as you mentioned, where maybe you think that the market in general is going to continue to decline, but you think that, technology stocks, for example, are going to outperform energy, right? You think that they're going to be not able to wade away from the kind of general market moves in that direction, and they're going to trend with the market, but you think that's going to be an outperforming, whether it's asset class, sector, industry, individual companies, or stock names. This is the time, I think, where you're going to start to see some dispersion, and really the best active managers will kind of rise to the top, right? And the ones that are kind of closet indexers, or ones that are much more, I guess, correlated to general market moves, may end up getting washed out. And again, there's going to be some pain there, but at the end of the day, this is going to be kind of at least one would hope, is kind of a refresh cycle, right? Where you do kind of get rid of maybe potentially some of these zombie companies that, were propped up on very cheap debt for a lot of this cycle. And now the fact that you've got financial conditions tightening a bit, they're not going to be able to necessarily survive. And when I say those types of things, obviously there's, again, going to be economic pain and employment pain, but we've been past the point, or well past the point, where we needed some type of really kind of reset to the system, especially when it comes to the crazy amounts of public and private debt that we're seeing. So again, there's silver linings to all of this, but certainly don't think we're out of the woods yet.
Yeah, actually stay the course. Got to stay the course. Kevin Kelly, Delphi Digital co-founder, thanks so much for joining us on the program. You stay safe. We'll talk to you again next week.
You too, Jeff. Appreciate it.
Bye. Welcome back. And now we're going to shift gears, talking a little bit about real estate. And joining me on the line, Jacob Passy. He is the real estate reporter for Dow Jones Market Watch. Jacob, thanks so much for joining us on the show this morning.
Thank you for having me.
It's great to talk with you. So before we kind of jump in, how are things going? How are you and the team at Market Watch doing?
Team is doing, as well as we can, given, how crazy this situation is. I, of course, trying to stay fit and stuff, and managed to sprain my ankle doing yoga at home.
Oh man!
So even though I haven't left my apartment in quite some time, still managed to injure myself somehow. So trying to. I'm fine now. I'm fine.
Are you icing
it's
it?
better or whatever.
Okay. So you're icing it,
elevating it, doing all that. It's hard though, because when I called my doctor to see if they could, if they had any advice beyond usual advice, and they basically say, well, for something like that, you need to get an X-ray usually. And I kind of just said, well, I'm not going to go into a hospital or whatever to get an X-ray right now for something that probably will heal on its own. So just hoping that it does heal on its own, and I can deal with all that later.
Yeah, I've had those bad sprained ankles, so just take care of it, elevate it, and don't do too much. It takes time, you can't shorten that time frame. Well, we're not going to do any yoga, but we're going to do real estate conversations. So what's top of mind for you and the team at MarketWatch this week when it comes to real estate?
Yeah, so there was a report that came out from Atom Data Solutions. They're a company that compiles and tracks data related to the real estate market and mortgage market, and they put out a report looking at which counties across the country were most vulnerable to downturn as a result of the coronavirus situation. Mm-hmm. So, and what was interesting about this report is, and it kind of follows some of the other reports we've seen related to, unemployment and things like that, is, the number of cases in a county isn't necessarily indicative of, how vulnerable that area's, economy is to the coronavirus. So, mm-hmm. Some of the big cities in this country, that have, Seattle, for instance, was actually one of the housing downturn as a result of the coronavirus, even though it's one of the epicenters nationwide of the outbreak. So that was kind of interesting. And the cities, or rather the counties, that are vulnerable are mainly located in the Northeast and the South. So 14 of the 50 most vulnerable counties to a coronavirus-related downturn are actually located in New Jersey.
Wow. Okay.
Which kind of makes sense. A lot of folks in New Jersey work in New York City. So even though in New Jersey has had obviously quite a number of cases, but not as many necessarily as New York City proper, which wasn't among the counties that make up New York City were not among the most vulnerable, but a lot of the suburbs of the city were. So that kind of speaks to lots of folks who live in the tri-state area, New York, New Jersey, Connecticut, commute back into New York City for work, and so the ripple effects that the shutdown of New York City basically has had on those other economies in the area will be pronounced. Researchers found some other cities, some other counties were located, down in the South, in Connecticut. So it's those were the parts of the country that were expected to see a big downturn. Interestingly, Texas was expected to be quite strong relative to the rest of the country. Mm-hmm. And I say that's interesting because Texas has kind of had this interesting double whammy where there's the coronavirus situation which is affecting all parts of the country, but then because of the large oil industry in Texas, there's been a major downturn in oil prices in recent weeks because there's less demand for oil. And there was a lot of, ongoing, conflict between Saudi Arabia and Russia, which was causing international to drop. So, the oil industry is a big one in Texas, and so this has been kind of a double whammy for the state. But they found cities like Houston are going to probably, withstand this fairly well. And that probably speaks to, the strength of the housing markets in those areas. Mm-hmm. The growth in those housing markets has been very natural. It's been driven by demand. There's not too much speculation going on. So similar with the West Coast, there was only one county in the West Coast that was among the most vulnerable. And otherwise, even though cities like Los Angeles and, like I already said, Seattle have had a large number of cases, the demand for homes there is driven by, a low supply. And so even if a number of homes were to come onto the market, or there were to be, an uptick in foreclosures or anything like that, it wouldn't necessarily have, the wide-reaching effects that we saw during the 2008 crisis.
Yeah, well, so obviously, I think a lot of there's always obviously speculation, Jacob, in terms of whether we have a V recovery after this is all over, because we'll get through this at some point. But is it your sense that this, depending on the type of recovery, that this could perpetuate and delay people, for example, moving? I would think Texas would be a great area to live, but I do know that obviously oil is significantly impacted by what's going on internationally. There's the Russia-Saudi Arabia connection that has some issues in creating havoc. Obviously, it's coronavirus. But what's the trickle down effect, for lack of a better term, or domino effect that relates to housing longer term from something like this?
Yeah. So one of the big issues right now is just the main thing we're seeing in the housing market right now is a slowdown in listings. The number of listings has dropped fairly significantly year over year, or very significantly year over year, and very significantly month to month. This is normally when you would expect to see listings increase because it's the spring home buying season, but we're seeing the opposite. We're seeing listings go down. And that kind of speaks to the fact that at the end of the day, if you can't move, you're not going to put your home up for sale. If there's a lot of folks who are trying to move right now are facing difficulty, hiring movers. There's concerns about, having other people go into your home, whether that could spread the virus, all that. So all that, and a lot of the shelter-in-place orders don't necessarily allow for those activities. There's, it's a little bit of a question mark. So whether that's essential or not. So, with all that in mind, that makes it much more difficult, I think home sellers are a little skittish. And also, they're home sellers, they're going to put their home on the market if they feel confident they're going to get a good price. And I think right now there is the wide understanding that a lot of folks have encountered major financial difficulty as a result of all these business shutdowns. And then on top of that, there's also the fact that a lot of folks, their down payment is tied up in the markets. And although the markets have rebounded this week, the downturn these past few weeks has hit a lot of folks really hard. So if you had, the money you were planning to use for your down payment invested, that money quite possibly has not recovered its value to what you might want, and that could constrain your ability to buy. So sellers are aware of those issues and are, shifting away from selling. The interesting thing I do think is and I've talked about this with my colleagues, is whether we're going to see a pickup in the rental market, or what's going to go on in the rental market. Because one big trend right now, which this kind of touches on my other beat that I often cover too, which is travel, is what's going on with Airbnb. So Airbnb this week put out, guidance for its hosts, basically encouraging them to shift towards longer-term rentals. So shifting away from 1 week or 2 weeks to, a few month-long rentals. And that's, to try and compete, that would help Airbnb compete with other sites out there that are more geared to the longer-term rental market. But you also see some Airbnb hosts across the country shifting towards just more traditional tenants for their properties, folks who are going to sign a year-long lease rather than, the short-term stay market. And that could have a big impact on rental prices across the country. A lot of cities, there's been, ongoing complaints over the past couple of years that the shift towards Airbnb among a lot of property owners has led to rent prices going up in like Nashville, Austin, some of these popular tourist destinations especially. It's been a big issue for renters in those cities finding an affordable place to live, and Airbnb is a part of that. So you're seeing kind of anecdotal evidence of Airbnb hosts shifting towards more traditional rentals, and that could help renters find more affordable places to live because it's increasing the supply of housing in those areas.
Let me ask you this. What about people who have lived in urban areas, I mean, New York City, the tri-state area, that are going through this, and are they going to be rethinking perhaps living in this area and maybe wanting to relocate to other parts of the country? I mean, could we see I don't know, not a mass exodus, but could we see people just kind of, because it is very saturated here with people, right? I mean, you and I both live
Right.
in the area, a lot of people moving around, and so we're all sequestered now. But do you think there are people that are going to rethink their living situation and where they're living and say, do I want to remain here?
Yeah, I mean, I think, on the one hand, it's a little too early to tell. I think, that will be something that a lot of folks in the real estate industry will look for in the data of, related to migration trends for the years to come, is to see whether this leads to an exodus out of urban areas into the suburbs and exurbs. I've done reporting before, though, that, the flip side of all this is the exurbs are somewhat more risky places to buy historically, just because, when there's a downturn there there's less services out there, things like that. People don't want to live so far away from where they work because then you're paying more for gas and transportation. So the exurbs are often the first areas to get hit hard by a housing downturn. And if this leads to a housing downturn, it'll be interesting to see whether urban area residents decide to flee and take advantage of potentially lower prices in the exurbs. But also, I think, there's been this ongoing idea that, millennials don't like living in the suburbs and exurbs, and that there's been this kind of generational shift towards more urban living. And that is true to an extent, but it is also somewhat overstated and reflects, kind of a mentality that a lot of us writers and journalists and researchers are located along the coast in major urban areas. There's certainly plenty of millennials who live in the suburbs, in the Midwest, in the South, in the Southwest. Those areas are still thriving and largely have rebounded from the 2008 crisis. So, with all of that in mind, the suburbs are still, the suburban ideal of, a nice home, detached home for your family with a yard. That all is still true, and by and large, the reason people move is for life reasons, like having a family, things like that. And so those factors will probably weigh more heavily than, a pandemic. But there's also an extent to which there probably at the margin are people who, are saying, I'm done with New York. Especially if you, lived through 9/11 and have now lived through this, you might be a little bit more anxious about living in the city. So those types of people might, move out from the city and find, a home in a less densely populated area.
Yeah, I'm just interested. I think it's going to be fascinating once we get through all this pain, and maybe we get through the recovery to see how people what actually winds up happening if people start to move, reassess their lives. I think we all got kind of, and it's not just 9/11. It's not just this. I mean, people lived through the 2008 crisis. I mean, there's so many different things that impact people. I think it's going to be really interesting to see. Jacob, always a pleasure chatting with you. Make sure you ice and elevate your ankle. Take care of that, and maybe you can do some yoga from the waist up, right? I mean, that's a possibility.
Hopefully. Gotta stay fit.
All right. Stay safe, my friend.
1, 2, 2,
all right.
Take care. Bye.
Snoop Doggy Dogg and Dr. Dre is at the dope.
Welcome back, and now we're going to talk a little retirement, or a lot of retirement, I guess, in this case. And joining me on the line, she is from Dow Jones Market Watch and a retirement reporter there, or the retirement reporter there, Ms. Alessandra Melito. Hi, Ali. How are you?
Hey, how are you?
Doing quite well, all things considered. It's a good Friday, so markets are closed, so a lot of clients are shuttered. That's always good for them, and kind of taking a fresh look at what happened during the week. But I'm really happy to speak with you and the rest of the contributors. Let's start. What's top of mind this week? We had a short week, but is there nothing going on? I mean, give us your take on news for the week.
There's always something going on nowadays.
That's true.
So one of the stories that I wrote this week was about people who are nearing retirement but were just laid off. The unemployment numbers have, been steadily, this past week I don't think it was the record high. The week before was the record high. But there have been significantly larger numbers of people filing for unemployment. Mm-hmm. So I dug into it a little bit about those who might be at an age closer to retirement. Unfortunately, with the weekly numbers, they don't dive too deep into age groups. They say like adults versus, teenagers or whatever, but they don't go age by age. So I reached out to the BLS, the Bureau of Labor Statistics, and I was able to get some numbers. So from the current population survey of households, I found that 1.2 million people who are 55 and older were unemployed in March. Now, the problem with that is that number is probably a lot lower than than the figure actually is. With that particular survey, they only do it until the middle of the month, which means that next month we will see an adjustment for March. Because, as you know, a lot of the businesses were only starting to shutter in the middle of the month. So I can only imagine what the numbers actually are from like the 14th to the end of the month. So we'll see that. But it was just interesting to see, because even though that figure only goes up to the middle of March, it was still higher than February and other months before it. So you are starting to see that trend, even if it is a delayed figure. So I spoke to some financial advisors about what people should know if they're near retirement but they just lost their jobs. That's a very important and sensitive time, and it's when a lot of people are making up whatever money they weren't able to save when they were younger because of, a mortgage or kids or student loans or anything like that. That's the catch-up period. That's why the IRS even has a catch-up contribution age, for people 50 and older, because that's when you're ramping up your efforts so that you're ready to go for retirement. People said that the first thing you should do is take this opportunity to get yourself financially organized. Not everybody has a financial advisor, but if you do, or even if you don't, try to consolidate all the information, organize every financial account and document you have, and see where you really are. So if you have a financial advisor, they probably already did that for you, but it's good to do a little check-in to make sure that you know where you stand and what you need for your retirement, Mm-hmm. And it's important to ask yourself questions like, how much money do I need to uphold my lifestyle, and what expenses do I have coming up? How will inflation affect my cash flow? What am I not expecting? Obviously that question is hard to answer, but there are categories that you could take into consideration, like a home improvement. You might need a replacement for a roof, or healthcare. We all know that healthcare is a really expensive thing as it is, but it only gets more expensive as you get older. So you might be underestimating how much you need in retirement, and it's important to overestimate all of your expenses because you don't want to be below. You'd rather be above your expectations. Yeah. And then let's see. So a lot of advisors were just saying, like, there are a lot of options to weigh right now, brushing up on skills, creating a resume or updating a resume, making sure that, at least for the time being, you have health care coverage. If you were let go, do you need COBRA? COBRA could be really expensive and unaffordable for some people, so what do you do instead? If you get a severance package, make sure healthcare is included in that. Mm-hmm. A lot of people don't get severance packages, but just in case you do, that's a great benefit, but make sure you really read through the fine print, because you don't want to be not under healthcare coverage at a time like this, especially. And just, try to stay calm. Don't burn bridges. One advisor brought up a really great point. She said that just because this is a terrible time for you to have to go through this, but don't burn the bridges with your former employer, because there's a likelihood that they just couldn't keep everybody on payroll, and that when this is all over, they'll bring them back. Not everybody was technically furloughed. Some people were just laid off, but there have been times in the past where companies will go back to their former employees and hire them either full-time again or part-time or as a consultant. But, that relationship isn't over. It's just everybody is in the middle of a crisis right now, and we just have to take it day by day.
Yeah, I think that's really good advice, to get your financial plan in order. Know your debts, know your health care. And my understanding, Allie, correct me if I'm wrong, but I think they're going to open up the exchange so people can, if they're not getting COBRA or they can't get health care through their employer, they can go through an exchange where they live, right? Am I wrong on that? I think I heard that the other day on a press conference.
I think I heard that too, but I am not too familiar with those rules yet. I actually have to brush up on that.
Okay. And yeah, I think that's really important. I guess my longer term worry is much like in 2008, when we people lost their jobs or they had significant market depreciation and then they had to work longer. And I wonder with companies reducing match benefits, right? We talked about that. You and I have talked about that. We've talked about it on the show and the network, et cetera. And I'm wondering what the impact will be. And I don't think we have the answer. I think what is going to be the answer to retirement? We talked earlier in the week, you and I, on the network about FIRE and what potentially could be the impact to those who are already retired and they're part of the FIRE movement. But I'm worried about people that are getting close that you were just talking about, without the ability to save and that compounding. Where's retirement? What's retirement going to look like? Where are we going to be in a few years with this major event happening?
Yeah, I mean, it really depends on the person's specific situation. Unfortunately, that might mean that some people have to work longer or work part-time in retirement just to, fill that gap until they decide to claim Social Security or anything like that. But it's stressful because people, sometimes they aren't able to save enough for retirement by the time they're 60 years old. And if they are in the middle of this and, companies aren't necessarily hiring or, everything's on pause. And even if they were hiring, you can't really start your job, or you were supposed to start a new job, but now you can't because everything's on hold. It's chaotic, So as far as retirement goes, it really depends, because some people are also, they're going to have to take loans or distributions from their 401k, and that was something that the stimulus package opened up for people. They increased the limits for loans and distributions, and they included coronavirus-related consequences as the reason for a hardship withdrawal. So if you're taking money out of your account, you're hurting your future nest egg, but you might need to, because you don't have a job right now. It's just, there are so many factors that will go into how retirement, what retirement looks like in the future. And it's just a matter of, when we'll get over this particular crisis right now, because everything is on hold.
Yeah, and as you always advocate, it's about breaking it into different pieces, smaller pieces that you can, because if you go after one big goal, I'm going to be financially secure, that's so ambiguous and generic that, you can never achieve it. But if you break things down, I'm going to do, on this day, I'm going to work on my resume. On this day, I'm going to do this. On this day, I'm going to decrease my contributions or increase my contributions. I'm going to reconcile my college savings, things like that. I think that's probably a more manageable way to do it than just that ambiguous goal.
Even though we're all stuck at home, it could be very overwhelming very fast when you think of your to-do list. Like, I'm stuck at home, but I'm still working, and when I think of all the things that I have to do, even though I'm at home, it's it's overwhelming. So I can only imagine what it's like for somebody who now they feel this pressure of not being able to retire when they plan to retire, or not being able to see their retirement the way that they wanted to see their retirement. It's just important to take everything day by day, get yourself organized, check your cash flow. Talk to a financial advisor if you have one, or maybe start looking into potentially working with one in the future, when you're comfortable to do so, and just trying to stay calm and safe right now.
Absolutely. Well, she is the retirement reporter for Dow Jones Market Watch, and she is a bellwether of all things retirement. Ali Melito, always a pleasure chatting with you. Stay safe. Appreciate your insight, and we will talk to you again next week.
Yeah, talk to you soon.
Bye. Come back, and now we're going to shift gears and talk a little bit about retirement legislation and then a whole bunch of other things. And joining me on the line, they are known as the Legal Eagles. David Levine, Kevin Walsh, both are partners with Groom Law Group, an employee benefits law firm based in Washington, D.C. Gentlemen, thanks for joining us on the podcast this week.
Thanks for having us, Jeff. It's good to be here.
Yeah, it's great to have you guys, and you did some double duty, Kevin, this week. You're on every day, Monday through Friday, talking about the CARES Act and all points in between. First, on behalf of the audience, let me thank you guys for doing that. And Kevin, why don't you take us through and maybe recap kind of what we talked about?
Yeah, so I mean, I think people, if you're interested in more details on this, we did a series of podcasts with Jeff this week. I mean, we have about 75 minutes now of CARES Act material, thanks to Jeff's efforts. But this week we talked a fair amount about the three different kind of constituencies that the CARES Act tries to address in terms of providing some economic relief from the impact of the COVID-19 crisis. So first, we talked a little bit about what individuals, how the CARES Act helps individuals. So it helps individuals in a couple of ways. One is it makes it easier for them to take hardship distributions. So it allows it allows hardship distributions, and it allows the taxes on those hardship distributions to be paid over kind of an extended period of time. The second thing that it does for individuals is it increases the amount that they're allowed to borrow from plan loans. So really, if you're an individual, it's probably worth, and you're dealing with some of the COVID-19 hardship, it's probably worth taking a listen to, I believe it's Monday's episode, where we talk a little bit about these loan programs, these hardship distribution programs that help individuals. So that's individuals. Small businesses, so 500 or fewer employees. We had a pretty robust discussion about the Paycheck Protection Program. And this is a brand new program that was launched by Congress in the CARES Act. And what it does is it provides for loans of up to $10 million based on the employer's payroll costs last year. And if those loans proceeds are used in a certain way over a certain period of time, those loans can be forgiven. So essentially the loan gets converted into a grant. That's totally worth taking a look at if you're a small business and you've been impacted by the COVID-19 crisis. It's also helpful because if it helps you make payroll, it helps you keep people employed. We also talked this week about what can help large employers. And just at a high level, there's really two programs out there that were created by the CARES Act that help large employers. First is the Employee Retention Tax Credit. And this is a credit that's available to all employers who don't use the Paycheck Protection Program. And it's available if you have employees who are not working but are being paid because your company has suffered a 50% decline in gross revenue, or because your operations are partially or fully shut down as a result of a government order related to COVID-19. And what it provides for is for refundable tax credits of up to $5,000 per employee. So that's a pretty big program that can help larger employers or those who don't use the Paycheck Protection Program. And the last thing that's available for big employers and basically employers who don't use the Paycheck Protection Program is there's an ability to defer your payroll taxes that would be due from essentially the end of March in 2020 through the end of 2020. And they'd be due in two kind of lump sums. So half would be due by the end of 2021 and half would be due at the end of 2022. So this is kind of a mechanism for managing your cash flow today by putting off liabilities that would be incurred this year into 2021 and 2022. Now, we've talked about these programs in a lot more detail in our podcast this week with Jeff. If you want more information on them, we suggest you listen to those podcasts. And David, we also talked a fair amount about what plan fiduciaries could think about or should be doing as a result of kind of the crisis apart from the CARES Act. Do you want to talk a little about that?
Sure, absolutely. And I think just to do the quick recap on that, and I think you put it well, Kevin, we definitely did a deep dive and went to all the nooks and crannies we could find. Let's talk about a couple different things to focus on. If you are a plan sponsor, do you have the cash resources for your plan? If you're doing the PPP program, do you have cash resources from there? But I think one of the key things is, okay, are we going to continue our employer contribution levels at this point? If we're going to change a match, if we're going to change a non-elective contribution, heck, in some cases, maybe even we're going to increase for some people who are working really hard. What is the economic impact? Can we change them? For safe harbor plans, you have notice requirements. For non-safe harbor plans, you still may want to be notifying people. And what do you want to change? How do you message it? Because if you discontinue a benefit, it permanently discontinues something. It can be a partial plan termination. If you have a defined benefit plan and you're changing your formulas, you can actually have to give notices that relate to telling people what you're changing the benefits to. I know we covered this in a bit more detail on the Friday segment we did with Jeff on CARES this week. And I think it's very important to really think about, What does this mean in terms of my notices, my obligations? What have I promised people? And by the way, it goes beyond retirement. It goes to other benefit programs. What can you change? What can you not? So that's kind of design related items. Another sort of bridge between design and fiduciary is a lot of vendors have come up and said, this is what we're doing for the CARES Act. And the paperwork you get is sort of, I'm agreeing to add this, or I've agreed to add this. Some of that is settler or sponsor. Those are sponsor decisions. Do I want these things? Implementation, however, is fiduciary. So think about who approves what items. The reality is it's a gray zone, and I don't think there's perfection here, but that's kind of the crossover between sponsor and into fiduciary. And let's close out with fiduciary at this point. Fiduciary, there's a million different things to think about right now. Obviously, there's messaging. There's people talking about wellness, about what are our wellness programs doing? What do we educate? But you also have to balance the issue of education versus advice. If you're doing fund changes, how is that communicated? Again, the rules haven't changed, but think about, okay, time in and out of market. What are we telling people? Are we changing strategies? Given the volatility of the markets, it's important to think about that. Lastly, if you're thinking about, or almost lastly, if you're thinking about if you're thinking about vendor switches, or you have a vendor switch, how is everything going on impacting your vendors? The vendors are doing really well. They really are. But how does this impact things? And I'll keep adding a couple more because I should have never said lastly.
I think I'm going to start using the phrase "almost lastly" at the beginning of every talk I give.
And Kevin, you're right. Well, I'm just going to borrow from someone who people really like, Steve Jobs. I'll just keep saying one more thing. One more thing is security and privacy. Kevin and I love this, but security and privacy is important right now because everybody's working remote. What are the controls of controlling data for the plan as a fiduciary? Making sure things are protected. And I will actually sort of have a lastly type of discussion. It is also figuring out how you communicate to your employees during this time if they're working remotely, and making sure that they understand and answer their questions as they go forward, because so much is moving so fast. The educational process and just the communication process can be a challenge. That's a speed recap. Yep. Definitely, Jeff, thank you for having us on all week with our longer segments to talk about CARES. But I think there's a lot of things to think about, and it's just a matter of stepping through. I know our clients are really focused on it. I know, Jeff, you are at the Broadcast Retirement Network. I think hopefully we all just keep making progress and get back to opening up one of these days.
Yeah, and I'll just go ahead, Kev.
I was going to say thanks for having us on, and if there's a CARES Act 4.0, or if there's a big change in the coronavirus that kind of generates big changes in the retirement space, or new ways for employers to kind of subsidize keeping people on payroll, we're always happy chatting with you and your listeners.
Well, we appreciate it, and I want to say first, thanks, guys. Really appreciate it. This has been an amazing week for a lot of reasons in terms of what you guys have delivered. And I will post a link right at the bottom, so people listening to this and watching this on LinkedIn or looking at the podcast through Google Play or Apple, I will put the links to the other shows as well. So, gentlemen, I'm going to leave it there. Thank you so much, and we will talk to you again very soon, I'm sure.
Thank you so much, Jeff.
Thanks, Jeff.
Bye.
Well, that wraps up this episode of the BRN Sunday podcast. I want to thank our contributors who donate their time each and every week to help us analyze all the news. And I want to thank Mr. Michael Garman, partner with KBS T&M. Really appreciate him giving us the CPA's point of view to the CARES Act. Really some good things to take away there, I think, for the audience. And I want to thank you, the audience. You have a lot of things on your mind and dealing with a lot of things in terms of family and friends and work. So appreciate you stopping by. So until next week, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.